Hello finance folks. So in today's presentation, we will cover an important aspect where we will discuss timing the market, whether it's a wise strategy or a futile game. We will learn about the long-term investing versus the short-term mindset of timing the market. It will be a roller coaster ride through the highs and the lows of the investment strategies. We will also learn some behavioral aspects and as well as I will share some resources which will elevate your investment game. So grab your seat. We will be discussing a lot of things. Stay tuned, like and subscribe for more such information. So our today's agenda is to understand the market timing. What are the challenges of market timing and the cost of waiting on the sideline? What are the pitfalls of timing the market? And we will also cover the behavioral aspects. And finally, we will have some expert opinions from the institutionals or the perfect investors. Let's move to the understanding market timing. So understanding the market timing, it's like a dilemma which every investor faces, where the task is to decide the optimal entry and the exit points, where the investor try to balance the risk and the rewards in the investment decisions. Contrasting timing the market with the long-term investment strategies. There are benefits and the pitfall for each kind of approach. So we will understand how institutionals or the individual investors try to time the market by understanding the economic analysis, technical analysis, investor psychology, and the external factors. What they are actually trying to aim is to buy low and sell high based on the predictions. But we also have to live with the risk and realities. We need to understand the market predictions are uncertain. It's very difficult and risky to accurately time the market. We will also understand what is the investor's psychology, why they do the market timing, what are the emotions that are actually inhibiting the user of taking the rational decisions. So these are the challenges that I think we all must agree. The first challenge is predicting the market fluctuations. It is very difficult to accurately forecast the market's highs and lows because market react unpredictably to the news, events, or the economic data. Other main challenge is the emotional decision making. Like when we try to time the market, we are attracted toward making a financial decision based on our emotions, which means that we are not rationally taking the decisions. And secondly, when we are trying the market, the other participants are also doing the same thing. So as a result, it leads to the herd behavior, leading to the poor decision making. There are a lot of external factors like geopolitical events, policy changes, economic shift, which can derail the market. And many times it is difficult to factor in the potential global influence in the market. And finally, we will discuss an important aspect, like it's a debate from over many decades, the timing versus time in the market. Historical data shows that time in the market is more important, but we will also see from a very beautiful illustration from S&P data. And finally, the cost and the resources is also an important consideration, because if you try to time the market, the transactional cost and the taxes are very high in that case. Secondly, the significant time and the resources are required to perfectly time the market. So these are the main challenges that we face with the market timing. And now we will also explore the cost of waiting on the sideline. First thing is that perfect timing is an illusion in itself, because it's very difficult to predict the bottoms and the peak of the market. You cannot perfect the market entry point, right? So other thing is the historical misses. We have found in many instances when people are actually bearish about the market and market makes a significant gain. As a result, you missed on you miss the important investment return that you should have gained, right, if you are actually perfectly timing the market. The third thing is the opportunity cost, because you are sitting on a cash just to trying to time the market. Eventually you are losing the opportunity cost of staying invested in the market. And fourth thing is the compound interest effect. Like when you are not invested in the market, you are actually missing a lot of things. For example, there might be some dividends which could enhance the returns. There might be some right options, or there might be some stock splits which eventually you can get if you are always invested in the market. However, because you are sitting on a cash and as a result you are not holding those securities, so it has a significant long-term implications on the investment returns. Finally, the psychology of waiting, because as you are waiting, you are sometimes hesitant, or sometimes you are fearful, which are eventually also delaying your investment decisions. And finally, the behavioral biases, which could be like overconfidence bias or overweighting or anchor bias. So they also play a significant consequence on your investment decisions. And this is the presentation that I was talking about. According to this presentation, so what the total returns of $10,000 investment in S&P 500 between January 1st, 2003 to December 30th, 2022. A similar exercise was done from 2005 to 2021, but this study contains data for 20 years, so I have picked this data. The impact is that if the investor was fully invested in the market, then the returns were 64,000 from the initial corpus of 10,000, right? But if investor misses the best 10 days, the returns are even less than 50%. So you could only make around $29,708 if you missed the best 10 days. These are the best 10 days. Like on 2008, October 2008, the market rose about by 12%, but it was the most bearish phase of the market, and in that bearish phase it made a 12% rise, and investor could have easily missed this, because as we know that whenever markets start going down, all the investors try to think that the market will eventually again go down, and eventually all of a sudden there is a huge upside which most of the investors miss, and they try to again and re-enter into the market at the high point of the market of that time. And you will see the irony that this losses are even severe if the investor missed around 60 best days. So it could lead to the deterioration of 93% of the wealth, right? The final returns are almost 4,205 rupees or dollars, right? So this is the implication of not staying in the market. So eventually what we understand is that it's best to stay invested in the market, because eventually you gain from these best days, whereas if you try to time the market, most of the time you will miss these best days where the market make a significant up move, and as a result your losses or the average annual returns could be very less as compared to the fully invested case. And we are now also going to discuss the behavioral aspect. First thing is that when individual investors or the institutional investors try to make the decision based on the emotions, the emotions related to the economic indicator, but those things are actually a collective emotions of the investors. The two dominant emotions are in play: fear and greed. Fear can cause us to panic and sell off our investment during market downturns, missing out significant potential gains when the market recovers. On the flip side, greed can push us to make risky bets during the market boom, often leading to losses when the bubble bursts. These emotional responses can lead to impulsive decisions like buying at the market highs and selling at the market lows, which are detrimental to our long-term investments. And there are also cognitive biases. These are the psychological biases that skew our investment decisions. For example, the overconfidence bias. It's when we believe we can predict the market movements accurately, often leading us to take unnecessary risk. And similarly, we have a confirmation bias, our tendency to seek out the information that confirms our pre-existing beliefs and ignore the evidence of the contrary. This belief can create a narrow view of the market. Lastly, I think, which is the most common one, the herd mentality. It is when we follow the crowd in investment decisions, often leading us into the market bubbles or crashes. The pitfalls of the emotional decisions. The pitfalls are that in the numerous instances where emotional decisions have led to the poor market timing, panic selling during the market lows or exuberant buying at the market highs can significantly damage our long-term value of the portfolio. And finally, we will also discuss the rational versus the emotional investing. The key here is to adopt a disciplined, research-based approach to investing. It involves making decisions based on the thorough analysis and sound strategies rather than emotional reactions. Strategies to mitigate emotional decision making include diversifying your portfolio, setting predefined investment criteria, and avoiding the herd mentality. Finally, let's touch upon the economic insights. Finally, psychological factors that drive investor behavior can greatly improve our investment decisions. Studies in this field reveal how emotional biases often lead to suboptimal market timing and the investment choices. Learning from these insights can help us to avoid the common pitfalls and make more informed decisions. In conclusion, I will say emotions and biases are inherent part of the human nature, and recognizing and mitigating their impact on our investment decision is very crucial. By being aware and adopting a more disciplined approach, we can navigate the financial market more effectively. Okay, and finally, we will move on to the expert opinion section, where we will discuss like what investors like Warren Buffett has to say about the market. I think this is the most important quote that I read, is that stock market is a place which is designed to transfer the wealth from the active to the patient investor. By patient, Warren Buffett means the person who is fully invested in the market all of the time, whereas active investor is always trying to time the market. And similarly, Raghunath Ranjan, this is from the Indian context. The problem in trying to time the market is not just about timing the ups, but also getting the timing of the downs right. More often than not, you end up getting up either of the two wrong, right? So the problem is you trying to time the market. It's not just about timing the ups right. You have to also time the down right. And what Ranjan is trying to emphasize is the difficulty and the risk involved in the market timing, right? It is very difficult to time both the aspects correctly. And finally, these are the additional recommendations that I will recommend you. These are the few books: The Intelligent Investors, One Up on the Wall Street, Common Stocks, and The Uncommon Profits, which are very good books for an initial investor who is just trying to invest in the market, right? And these are also words of wisdom for the person who is a seasoned investor. And there are some additional educational websites. Whenever you are in doubt, try to refer these kind of websites for your more understanding. And you can also try to reach out to me if you feel that I could be a best person to answer those queries. I will try my best to source the answer, or whatever, if my wisdom allows, then I will also try to give my answer in my own words. But I will say best of luck for your future endeavors. If you have any doubt, feel free to reach out to me over my comments. Thank you for your time. Bye.